What has been the change of the price goods from China? Almost
That's
nothing.
Wait a second.
Almost
Korea. That's the Asian bloc.
If Steve's right.
No, that's not true. The Asian bloc now is in full revolt against the cheap dollar because their exports are getting
that would be
enormously.
great.
See, Steve, here's the problem. You're right.
It's their problem as much as it's ours.
But can't you see the handwriting on the wall? See, this is why we have to worry about this today.
But Steve
because
Liesman is giving
eventually they're going to figure it out.
But
here's a prediction. Be tied to our currency.
Dave Goldman, Steve Liesman is giving the clearest explication of the Argentinian model, of devaluing your way to prosperity.
Absolutely
this is Argentina.
You are giving a essential planning explanation for the dollar.
Dave Goldman, why is Muriel Rubini, just in a moment or two, as we promote you think Rubini is full of nonsense about this asset bubble from the dollar carry trade? Just give us a quickie. What's going on with there is a dollar carry trade, is there not, because of the negative real interest rate?
The dollar carry trade is the purchase of mortgage-backed and commercial mortgage securities by the banks who are getting cheap funding from the Fed. That's a mini bubble. It will tend to diminish bank stocks, but it's not a crisis. There's no evidence that there's massive borrowing in order to buy American stocks and commodities. What you simply have is a fire sale of the economy and a repricing of stocks with international cash flows or international tradables. That's not a bubble. It's simply a formula for stagnation.
You know, that fire sale, by the way,
to
Steve Liesman, that means all those Main Street workers are going to be working for India and South Korea and China. They're all going to just take over our stuff. If we make the dollar cheaper, they're just going to come over here and just buy us right out. Is that what you really want?
No, what you really want, Larry, is central planning for the dollar. You tell me which market forces argue for a higher dollar, other than you want a central planning.
Wait a second. No, I'll tell you.
Central
markets are smarter than Fed bureaucrats. Gold is arguing for a stronger dollar. All right, that's very important.
Far bigger
Commodity baskets are arguing for a stronger dollar. And quite frankly, I would argue, Rick Santelli will close on this.
3.5% on the 10-year.
The stock market is arguing for a stronger dollar. One of the things, Rick, I want to finish where I began with you. This is the first time I can remember. The Fed did not change its extended period phrase. So we're going to have a zero interest rate now for an extended period. Nothing changes. How come stocks went down after that announcement, Rick? What's your quick take on that?
Well, my quick take is that stocks think the notion of easy money is going to buy the U.S. and indeed the world economy enough time to come out of this. But what they don't understand, I think, is the reason the market went down, like the small business. Steve's right. Nobody wants to pay more. But when you make an environment so you can't exist outside of the subsidy of cheap liquidity, they figure it out. And I think in the end, a lot of the data that we're getting shows that even though there's improvement, it isn't going to be enough improvement to pay for the deficits that create these cheaper dollars. This is the problem, Steve. We're going to let them do this until we can't do it anymore.
We're living in a fantasy world. The fantasy is that we can monetize $1 trillion a year worth of debt and get the rest of the world to pick up the tab. The Indian Central Bank just officially bought gold from the IMF, which is a big shot across the bow saying we don't like the dollar. The next
India has
drop
made
of the
one
dollar,
wrong central banking call after another.
The next big drop of the dollar.
There's so much wrong with this anti-American, anti-dollar rhetoric of you guys.
Going to attack
is
India.
Unbelievable.
All I will say to conclude this brilliant segment is
3%
the Fed is wrong.
Cover.
The Fed funds rate should be 2%, not 0, to protect our long-run future and price stability. And you cannot devalue your way to prosperity. End of line.
They fled to the dollar in the panic, Larry.
Thank you very much.
To the dollar.
Thank you, Rick Santelli. Thank you very much. Thank you, Dave Goldman. Thank you for Muriel Rubini. Now our next guest expects gold to go to $2,500. Let's find out why. Here's Frank Holmes, CEO and CIO of U.S. Global Investors. Frank, I'm sure you heard that calm discussion of the dollar, the Fed, and gold. But you've got a nice forecast of $2,500. Tell me why.
Well, if you just go back to all the commodities in 1980, everything but gold and silver have gone through on an inflation-adjusted basis those highs. Oil has, lead, zinc, nickel, etc. And if you take a look at the total money aggregates out, it just basically says that there would be 1980 prices would be $2,300 to $2,500 an ounce, and that would be a non-event.
So you're saying gold is going to catch up. Now, have the other commodities in real terms gone back to their old highs?
They haven't all gone back to their old highs. Oil hasn't, but oil did run to 147. And its inflation-adjusted price level a year ago, or 18 months ago, was about $85. So anything above $85 is going through those levels. And so I just think that you're in this sort of interesting market. But I come back to China. What India has done is not anti-America, anti the dollar. It's basically they have a culture that has towards gold. And they've always been what they call price takers. Is jewelry. The biggest consumers of gold jewelry. And every time gold corrected, they would come in and become a buyer for their jewelry demand.
But here's a question. Does the Fed's zero interest rate policy, which is going to go on for many months more, it's actually negative. Real interest rates are actually negative now, Frank. Does that help your gold call?
Any currency that has negative interest rates, what they're paying on money market funds, take away the inflationary rate, gold does well in that currency. And if you have continuous deficit spending, then gold becomes an extremely attractive asset class.
All right, Frank, how do you play it? Just give me real fast for investors. You don't buy the bullion, do you? You buy the stocks, as I recall.
There are times to be buying bullion, and I like to buy gold jewelry for the ones I love. And I think that's the fastest and quickest way for people to understand it.
How come you don't have any bling? I'm looking for your bling if you buy gold jewelry. Where's your bling, Frank? You should put your bling on when you come on the program.
Well, I don't have it that way, but I do give gold coins as gifts and silver coins all the time. But let's come back. 5% has always been recommended as gold bullion or gold coins, and then another 5% in unhedged gold stocks. And then you rebalance. I've always advocated that you don't buy gold to get rich. You have it for insurance, and it's a wonderful form of financial
What's your favorite
insurance.
gold stock, Frank, right now?
Well, there's a slew of them that we like, and those I mentioned earlier, that Royal Gold is a gold royalty company. Rand Gold, Mark Bristol's done a wonderful job protecting shareholder value. Now Yamana seems to be turning the corner. Companies like Silver Wheaton, these are all very interesting companies that give you tremendous upside.
All right, great. Frank Holmes, thank you ever so much. $2,500 gold. We're going back to test the old highs in real terms. It makes a lot of sense to me.